Today, I'm going to be the main presenter. My name is Lacey Campbell, and I'm the Senior Director of Strategic Initiatives here. Some of you are our current clients on the line, so it's good to see your names. We're excited to share some more data with you. I do see that some of you, this might be your first introduction to Cerebro. So I also want to introduce you to our founder and CEO, who's going to be on the line with me. Matt, thanks for joining.
Yep. Thanks, Lacey. Really excited to be here today. Really appreciate everyone turning out. I know it's a busy time, and we're looking forward to your questions. And I'll be on at the end of the remarks to be able to answer your questions directly. So please post them in the chat box and the Q&A box. We will be sure to address those at the end.
All right, so a quick agenda of what we're going to cover today. For those of you who are not familiar with us, I'm just going to give you a quick introduction, but I want to spend the bulk of the presentation really talking about the state of lending today. We're going to be talking about, the increase in lender activity, where we're seeing the shifts in the market, what's happening with the Main Street lending program. That was a big topic we discussed on our Q2 webinar, and of course, current loan trends. I do have a couple case studies to share as well, and then we'll talk about where we think the market's going, what to expect next. And as Matt mentioned, we are going to leave time at the end to answer some live questions through the Q&A box. So I want to start off with a quick analogy. Again, for those of you who are not familiar with us, I think everyone on the line could go online and figure out what the current mortgage rates are. You could do a mortgage calculator and very quickly figure out how big of a house you could buy. Generally speaking, the personal mortgage industry is a little bit more of a transparent market compared to what our clients experience as middle market companies. It's much more opaque in terms of knowing what size loans are available to a company of your profile, what type of interest rates are out there, what is the variability from lender to lender, and it creates a very inefficient process. So Cerebro Capital is really trying to improve every stage of the corporate loan process, everything from matchmaking borrowers and lenders using data, to deal management and helping to close those loans successfully. For those clients who have loans in place, we do have software to help you track the covenants and the loan compliance, and then ultimately helping you use data to understand when to time the market and when to refinance. So everything I'm going to be sharing with you today is really focused on the middle market. So that is our area of expertise. We really define that as primarily US-based companies, existing operations. That does include both sponsored and non-sponsored companies, but our clients are typically looking for loans between 2 to roughly about 150 million, both cash flow and asset-based loans. We do have lenders across the spectrum offering, senior, junior, unitranche options. And I'll share with you just a couple of data points to give you a sense of the data that we're seeing and where we're compiling this from. Year to date, we have received over $6.2 billion in loan requests coming through our platform. That's indicating to us there is certainly a big demand, not surprisingly. This is across 2,000 companies representing 30 plus different industries. The odds are we have likely talked with a company that has somewhat of a similar profile to yours. And again, we are collecting data from over 800 lending institutions. Those include the top banks down to the local banks, community banks, and then on our non-bank network. So let me switch over and start talking about the topic today, the Q3 lending landscape. What did we see happen in Q3 versus Q2? And then ultimately, what do we think is going to happen in Q4 and next year? At a very high level, there's 4 key takeaways that I want everyone to take from today's presentation. Number one, conventional lending remains constrained. And I do have an interesting graph here to show you on the right-hand side This is from the Federal Reserve Senior Loan Officer Survey. This was done at the end of July. They have not released their Q3 numbers yet, but I wanted to share this here because we are seeing these trends continue through Q3 and into present day. And what's interesting is to note the peak there close to the 2008 crisis and where we are today. It's very close, almost mirroring those 2008 numbers in terms of the percent of respondents indicating that they were tightening their credit standards. Number two thing to take away that we are going to talk a lot about here in a moment is the MSLP program. That's the Main Street Lending Program, has been limited. But the good news is there are other government-backed programs where we are seeing loans get processed and have success. Number three, non-bank lenders are stepping up to the plate. As we saw after the 2008 crisis, there was an increase in non-bank lending. We're seeing that non-banks are a good home for many companies. So I'll talk more about that in a minute as well. And number four, I mean, this is no surprise to anyone, somewhat obvious, but it's worth noting that the non-impacted industries, those are the ones that are progressing through and getting loans closed. So many lenders across the board are still pencils down for many of those directly impacted industries, such as travel or entertainment, even with some of the government-backed programs. So with that, I'll pause for those of you who joined a little late. I do want to remind you this is a live webinar and we are taking questions. If you have any questions as we go through the presentation, please put them in the Q&A box and we'll try to address those as we go. So let's talk a little bit about the Main Street Lending Program. This was a topic we talked a lot about in our last webinar in Q2, and it's been really interesting to see how this program has played out. Needless to say, it has not been as widely used or widely available as everyone had hoped. This is information from the Federal Reserve's survey as of late September. As of late September, only 80 banks across the country have participated in closed loans under the program. 80. That's out of thousands of lenders that could have been participating in this program. So very small portion. As of late September, only 252 total loans had been closed. Again, really small numbers here. The average size loan was 9.1 million. And if you take out the City National Bank in Florida, which had the most participation in their program, you're looking at an average number of loans of less than 2 per bank that have participated in the program thus far. This is a really interesting graph I want to share with you on the right. This is showing you the amount of loans in dollar value that the banks have funded under the Main Street program versus the bank's assets in billions. And you'll see that City National Bank of Florida, that is the red dot on the top left. So what this graph is showing you is they have a relatively small bank, but they did a lot of loans and they are far and away the outlier on this graph. They did about 38% of the total loans. So that's one tiny community bank doing 38% of the loans through the whole country. Now, the other thing that's missing from this graph are the big name banks. You don't see JP Morgan, Bank of America, or even Wells Fargo on this graph. In fact, the largest bank that has funded a loan, that's PNC, and they're about the 7th or 8th largest bank in the country, and they have only funded $25 million under the program. So you can again see the disparity in terms of the size of the banks, who's offering these, and just the program in general. So what this is ultimately saying is that the banks who are doing loans are going to be the regional and community banks, which are typically restrained to their geographic region. So if you aren't in the backyard of one of these aggressive banks, you likely missed out on the MSLP program. Now, we have a number of clients who have gone out and wanted to receive MSLP loans. The good news is we have funded close to about $60 million in MSLP loans for our clients. But we are getting the question, across the board, like, why aren't banks lending more under the program? With the government backing and the government guarantee, why are banks not participating? And so what this graph is showing you here is some of the responses to, again, the Federal Reserve Senior Loan Officer Survey that the results released at the end of September. That first bar on the left is indicating a very important, a large, red box, very important, that the respondent said the firm was in poor financial conditions before pre-COVID. 2019 or pre-COVID. And so that indicates that there's still a risk tolerance that the banks are not comfortable with. They really are not comfortable under the program, even with the government guarantee. The other graph I'll show you here is talking about who is landing MSLP loans. What loans are getting funded. Again, this is based on our experience, and it's mirroring the data that the Federal Reserve has issued. We've closed about $60 million in loans under the program. We have a couple other clients who are in closing under the program, but that is far fewer than the number of clients who were eligible for the program. And generally speaking, those clients who are getting MSLP loans are going to be those that have a healthy balance sheet. They're 50 million plus revenue companies, they're 5 million plus EBITDA, and the loan sizes are at that 10 million or higher number. The other important thing is that the MSLP loans are not rainy day money. In every case, we have seen the loans that have gotten funded have had very specific use of funds for our hard cost, growth capital, very specific use cases there. That has garnered more interest from lenders than not. I'll pause there. I have not seen too many questions come through in the chat window or the Q&A box, so feel free to post those. If there's any specific use cases you all have, you can post those there, and we'll try to address those either as we go through or at the end of the presentation. So I wanted to talk a minute about conventional loans. This is actually very similar to what we were seeing in Q2. This remains the same today. Conventional loans and commercial banks are definitely having issues around industries that are directly impacted. They are still pencils down on many of those industries. In order to get a conventional loan, you really need to be a very strong company right now. Strong cash flows in 2019 and through COVID in 2020. Full collateral support if you have EBITDA less than 10 million. The lenders really are not getting beyond 3x in terms of cash flow leverage. And they are certainly asking for personal guarantees for, again, those companies that don't have full collateral support. The loan terms are stable, it's very similar to what we were seeing in Q2. It's LIBOR plus 4 to 8, about a 3 to 5 year term. The ABL structures, within conventional loans, also similar to what we saw in Q2, not a ton of movement here. The advance rates are still lower than pre-COVID rates. The collateral requirements are higher than pre-COVID levels, and appraisals can take a long time. So there can be some delays there depending on the geographies and what the shutdowns are happening there. So that's something to keep in mind. Generally speaking, for these structures, LIBOR plus 3 to 7, 3 to 5 year term, and advance rate 65 to 85%, just depending on the asset class there. Now, some good news I want to share. There are other government-backed programs that we are seeing a lot of success in. And I would say, prior to COVID, many mid-market companies shied away from these types of programs. In fact, you know, a lot of bankers aren't even aware of all these programs. If you relied on just your own, you know, banker relationship, you might not have even been aware of that some of these exist. And the good news is a lot of clients are learning that they have very favorable terms. These also have government guarantees up to 90%, so it's limiting the risk on the lender. There's a USDA programs through the CARES Act that offers up to $25 million. The interest rates are going to be dependent on a bank by bank basis, but some of them are being fairly aggressive there. They're up to 10-year terms. You have to have US operations, but what's interesting is this USDA CARES program, it's not limited to just agricultural businesses. It's actually fairly open for a number of other industries, and it's an interesting program. The SBA 7A and 504 loans, roughly about a $5 million max loan size there, about a 6% interest, again, a 10-year term. Personal guarantees are required, but that is a program we are seeing get pushed through, and loans are getting funded. That being said, the SBA does have a backlog. You know, there is a bandwidth there. So if these are programs that you're interested in, I would get started sooner than later. Don't expect these programs, you know, to close or fund in a matter of weeks. It could be, you know, a multi-month process to get these through. Of course, Cerebro can help with this process and get these as fast as we can. Now, I want to share with you a case study specific to the USDA program I just mentioned. A client came to us really early in June and wanted a Main Street lending program. That was fairly early in the Main Street lending program sort of life cycle, and they were early to market. They, of course, heard of the Main Street lending program in the media and the news. And what was interesting is, you know, they had a company profile that most lenders would have considered a higher risk. They have fairly low revenue for what we would consider a middle market company, but they had a very heavy balance sheet and strong EBITDA margins. They were asking for a $6 million loan, and through the Cerebro's process, we were able to identify, you know, that they would be eligible for this specialty program. And the company had never even heard of it. And they were really thrilled with the terms that they received under the program. It's pretty attractive. It's a 10-year term. The interest rate, again, was about 6%. There were no personal guarantees required under this program. It was interest only for 36 months. And we were able to get them roughly about $800,000 more than they're asking for. So they ultimately were able to get $6.8 million. Now, I want to switch to our other point here and talk about the opportunity with non-bank lenders. If you're not familiar with non-banks, you know, that is going to be lenders who are not regulated under the FDIC or regulated in the same way that a commercial bank is. Our non-bank lending network comprises of, you know, SBICs and BDCs and private debt funds that can do fairly interesting terms. We are seeing across the board that non-bank lenders offer higher leverage limits than those commercial banks. There's less emphasis on collateral or personal guarantees. That being said, they are looking for deal sizes typically above 5 million. There is a preference for sponsor-backed or strong valuation companies, and they too are avoiding industries with any sort of supply chain or demand disruption. Their terms are, you know, LIBOR plus 8 to 15, 3 to 5 year structures. They do have a lot of interest-only structures, and sometimes there are prepayment penalties. But ultimately, there is a lot of capital commitments that are healthy in the non-bank space, and they have dry powder to burn. So I'll share with you a case study with one of our clients who, again, came to us in July, initially thinking they might want the Main Street lending program. They knew about the program because it had been mentioned in the media. They came to us, and you know, this was a company that had about 33 million in revenue, 13 million in EBITDA, but it was a B2C company. that had B2C receivables, which are not traditionally favored by commercial banks. And the data was really telling us that non-bank lenders were going to be an aggressive avenue, which turned out to be true. They were really thrilled with the terms they received. In fact, they received a $50 million loan, which is bigger than their revenue. That's something that we rarely see. It's quite aggressive. They were also thrilled to see that this non-bank lender did not require equity dilution. There's a little bit of a misconception that all non-bank lenders will require some sort of warrant or equity sweetener. In this case, there was none. The interest rate was LIBOR +9, and the advance rate was 87.5% on their AR, which for this industry was quite high and was fairly aggressive. So again, an area where we can really see that a company benefited from going into the non-bank space. So to summarize, I'll share with you one other case study of what we have seen in a shift from pre-COVID to Q3. So this is a client who we launched into the market prior to COVID. We actually were able to get them multiple term sheets from commercial banks at a full $30 million ask, roughly about a 5% interest rate. Again, it was a commercial bank lender. The COVID hit right when they were in the diligence and closing process, and that commercial bank did pull their offer because it was right, in that late May, sort of early April timeline. We were able to pivot very quickly. Again, we understood that the non-bank network could be a good avenue for them. We were able to get them multiple term sheets under the non-bank space. The non-bank lender came forward and they were able to provide multiple term sheets, again, depending on which one they went with, $10 to $20 million in a loan. Albeit the interest rate did double because we were now in the non-bank space versus the commercial banks. So this is really showing the tale of two lending environments of what commercial banks were willing to do beforehand. They pulled back during COVID, and now non-banks have opened up, albeit at higher interest rates and sometimes lower loan amounts than we previously saw. So where do we see the lending environment going from here? What is the plan for the future? Well, at this point, we really see two scenarios. If the economy continues to worsen, we do expect additional stimulus. We are around the corner from an election here, a matter of weeks away. I'm sure you've heard in the news all the talks about the stimulus. We have seen the government step up earlier this year, and we fully expect there to be new stimulus packages. Those potentially could expand the Main Street lending program, given there is a lot of earmarked dollars for that program that have not yet been used. There is a potential to expand the SBA programs or have new programs under government-backed loans, which would be a good avenue for a lot of clients. The other scenario is that a vaccine comes sooner than later and the economy starts improving as the pandemic subsides. And with that, we would expect credit markets to begin thawing and returning to pre-COVID lending fairly quickly after we have a eyesight on a vaccine and when we can, quote, return back to normal. So I hope you enjoyed today's presentation. As we wrap up here, I do want to remind you of the things that we can do to help. If you have not already had a loan assessment, reminder that is on our website. It is free. There's no cost, no obligation. It is, back to my first analogy, sort of like that mortgage calculator. You can put in your company profile and begin to understand, how big of a loan might be available to your company and what type of terms and what type of lenders that might mean. Additionally, if you have existing loans in place, now is better than ever to start looking at your loan compliance and your covenant requirements. We do have a software to help manage that and ensure that you have full visibility in all the requirements and reporting to your lender. That's very important in today's day and age, is keeping an eye on that loan compliance. So with that, I'm going to pass it over to Matt, our founder and CEO. I know there's been a number of questions that have come into the QA box. So Matt, I'll hand it over to you.
Yep. Thanks, Lacey. I'll take a few minutes here and answer some of these questions. One of these comes in from, I see here from Jeff is, the question is, can SBA 7A and USDA CARES loans be subordinate to the lenders with existing debt? And if the lender has more debt than the new loan amount, how do you get the lender comfortable kind of taking or allowing additional indebtedness to come on top? I would say that, the short answer is that yes, it is possible for banks to take to put in place a 7A loan or USDA loan in a subordinated position. The reason that banks can get more comfortable with that is that they have, in certain cases, 75 to 90% of a guarantee backing it. And so based on how they evaluate the strength of the cash flows and the excess collateral against the total debt, they can get comfortable with that. We've done that before, but we've also seen instances where the credit profile just didn't have what it was required by certain lenders to get comfortable doing that. And so what I'd say is that, there is, that is definitely something worth exploring. It is totally possible, and there's precedent for it. One of the other questions that we have is around the MSLP loans. A question around how long are they taking to close, and could I describe the underwriting process? The way that the MSLP loans are working is they are going through a traditional underwriting process that's set by the bank, the individual bank. And so each bank is going to have their own kind of process for doing that, their own timelines for doing that. But generally speaking, we're seeing it take something like 2 to 3 weeks to get a term sheet. And then from there, upon selecting a term sheet, it takes somewhere between 40 to 60 days to close. And so this is the final shot. The next 2 weeks is really the final shot where MSLP loans can really have a chance at closing before the deadline at the end of the year. That is the deadline for the whole MSLP program so far. Though we do expect it to extend, that hasn't actually happened yet. And so for right now, it's critical for any company that's considering MSLP to evaluate that and begin that process before the end of the month in order to make sure that you have a viable timeline to get it done by the end of the year. And that's definitely something we can help with. If you fill out a loan assessment, we can certainly give you indications of what the data says about your ability to access that. Another question here is, in the case of the study where the loan amount of 50 million exceeded top line revenue, could you explain what gave the lender comfort in providing that facility? I think that, there were really 3 key reasons for this. There was consistent cash flow generation by that borrower for the past 3 years, and they performed well during COVID, which really impressed the lender. The other reason is that their narrative to the bank really was able to make a convincing argument that additional capital would allow them to further accelerate the growth of the business and do that while maintaining EBITDA margins, which were quite high. If you may recall, I think there were somewhere between 20, 30%. And then the other side of it is, there were many other non-bank lenders that were not interested in moving forward with that deal under any loan amount. And what we found is that the non-bank lending market is much more niche, much more bespoke, much more customized than what you would find in the commercial bank market. And so in that case, it was a matter of using data to find the lender that was looking for that specific industry, that specific growth profile, and to be able to get those folks to the table quickly. And they were really excited about it. And so that's something where, I think it's really about connecting the right lender with the right borrower to make everything work in that case. Another question I see here is through Q2, that people witnessed a lending capacity and term sheets changed overnight with banking institutions. EBITDA multiple lending drastically declined from 3 to 4x to 1.5 to 2x. And the question is, do we anticipate banking institutions will continue to lend on lower EBITDA multiples, or could we expect this to reach higher EBITDA multiple terms through Q1 2021? Our view is that Q2 has certainly represented a massive freeze in lending we saw a big drop off of lenders expressing interest as they immediately turned inward to evaluate and protect their own portfolios. What we saw in Q3 was a thawing of the credit markets, certainly not anywhere near what normal levels were, but we did see a significant 3 or 4x increase in lending activity, loans closing, lenders coming back to the market to really evaluate new opportunities. And so the reason we believe that was happening was because after Q2, banks were really able to get a sense of where companies, which companies were going to be able to perform through this environment and continue to grow or continue to stabilize, and which ones were going to fall off a cliff. And so as they started to understand, as the dust settled, they became much more comfortable going in there and providing loans. In Q4, just in this month alone, we've seen almost more activity than the entire third quarter combined. And so we are seeing lenders stretch on that 3 to 4x side, and some even going beyond that as well. And so what I would say is that we're seeing that because we see hundreds of lenders participating. And I wouldn't say it's the majority, but I would say that it's when there's a good match between lender and opportunity. And so I would expect that in Q1 and Q2 of next year, if things continue to recover, jobs start to come back, a vaccine is released, et cetera, then we should be able to see folks return to more normalized lending levels. Until then, the way to access that is to be able to spend a lot of time getting in front of a lot of different lenders to be able to identify good matches, or you could use technology like Cerebro to be able to help make that easy for you. But I'd say that those are things where we're pretty optimistic about that returning, so long as vaccines come out and the economy starts to open up. Aside from that, I don't see too many other questions. Yeah, so I think look, that really wraps up our time. I know we're 2 minutes over. We want to be sensitive to time. So I'll take this opportunity to thank you all for participating today. Please reach out to us if you have any additional questions that we didn't get to. We're happy to answer those. And then if you have any loans or any questions about whether your company or loan opportunity specifically has a good chance of getting MSLP or other good terms in the market, please fill out a loan assessment and we'll be able to give you a data-driven response. Thanks so much.